In 1792, the United States Congress quietly enacted a law that would reshape the landscape of global finance for the next 2 centuries. On the surface, it appeared straightforward. A law to establish a mint, define the values of coins, and provide the fledgling republic with its own currency. But concealed within that simplicity was a revolutionary concept. This was the Coinage Act of 1792, the pivotal moment when America defined what money truly represented. It wasn't merely a bureaucratic regulation. It was a philosophical declaration that the new nation's prosperity would be built upon silver, gold, and something even more precious: trust. However, over the years, that trust would be tested, disregarded, and, some might argue, betrayed. The atmosphere is heavy with uncertainty. The nation is scarcely a decade old. George Washington presides as the first president. And within the Treasury, a young, ambitious individual is laying the groundwork for America's economy: Alexander Hamilton. Hamilton firmly believed that independence extended beyond politics. It encompassed money. Because without control over your currency, you relinquish control over your future. Back then, the United States lacked a unified monetary system. Commerce was utter chaos. People engaged in trade using Spanish pesos, British pounds, Dutch guilders, and even privately issued notes. Prices varied from one town to another. Paper money was viewed with skepticism. After all, the Continental dollar from the Revolutionary War had already suffered a humiliating collapse. Hence the expression, "not worth a continental." Hamilton recognized the remedy: a national system rooted in tangible metals, gold and silver. Thus, the Coinage Act of 1792 was born, a masterstroke of financial engineering. It established the U.S. Mint and, more significantly, defined the U.S. dollar not merely as a name but as a specific weight. $1 was precisely 371.25 grains of pure silver, approximately 24 grams. Gold coins were also defined at a fixed ratio of 15:1. In essence, one gold dollar was equivalent to 15 silver dollars. This wasn't arbitrary. It was a deliberate balance. Gold provided stability, while silver ensured accessibility. It was a system designed to cater to bankers and blacksmiths, merchants and farmers alike. But Hamilton's vision didn't end there. The act contained a clause so severe, so revealing of the founder's mindset, that it almost seems like a legend today. Debasing or counterfeiting the currency was punishable by death. Because, in their eyes, manipulating money wasn't simply fraud. It was theft from every citizen, a betrayal of trust itself. The act went into astonishing detail. It created positions for a director, an assayer, a chief coiner, and an engraver, all sworn to uphold the integrity of American money. Even the design of the coins was symbolic. One side would feature the word liberty and an image of freedom. The other would depict the American eagle, a new nation rising from the ashes of monarchy. Each coin was intended to remind people that America's money stemmed from law, labor, and liberty, not from kings or bankers. And for a time, it succeeded. The new dollar was honest, trustworthy, and tangible. The world took notice, and the United States gained a reputation for possessing one of the soundest currencies on earth. However, embedded within that system was a flaw, a ticking time bomb. The fixed gold-to-silver ratio of 15:1 didn't align with the actual market ratio, which fluctuated constantly. By the early 1800s, gold became undervalued under U.S. law. And what happens when money is mispriced? People hoard the undervalued metal or send it overseas. Soon, silver coins disappeared from circulation. A real-world lesson in Gresham's law: bad money drives out good. The system designed for balance had inadvertently created distortion. Yet, symbolically, the Coinage Act of 1792 remained steadfast, a foundation of national belief that money should serve the people, not enslave them. For decades, that foundation remained strong. The American dollar, defined by measurable metal rather than political whims, became a symbol of trust. But as the nation grew wealthier, more ambitious, and more entangled in wars and debts, that trust began to erode. Paper money resurfaced. Promises replaced purity, and the founding ideal that money must be honest began to fade into history. The Civil War would mark the first significant fracture. The U.S. government, desperate to finance its armies, printed unbacked greenbacks. For the first time since 1792, America's money was not tied to gold or silver. Inflation skyrocketed. Soldiers were paid in paper that lost value even before they could spend it. Ordinary citizens watched their savings vanish while speculators grew rich. The very moral line the founders had drawn in 1792 was crossed. When the war concluded, a new question divided the nation. Should America revert to honest money, gold and silver, or embrace paper money forever? Farmers and laborers advocated for soft money, more paper money to alleviate their debts. Bankers and creditors demanded hard money, gold, to preserve value. It wasn't merely economic. It was a moral conflict, a battle between the ideal of honest exchange and the temptation of easy credit. Then, in 1873, Congress made a quiet, devastating decision, one that history refers to as the Crime of 73. Without public debate, it demonetized silver, making gold the sole foundation of U.S. currency. Overnight, silver coins became worthless. Prices plummeted. Farmers were crushed under debts that only grew heavier. The Coinage Act's dream of balance was shattered. What began as a system for the benefit of citizens now served those who controlled gold and power. By the end of the 19th century, America was seething with outrage. Populist movements emerged, demanding free silver. And in 1896, a passionate voice captured that anger. William Jennings Bryan, declaring, "You shall not crucify mankind upon a cross of gold." It was the cry of an era, an echo of 1792, a demand for justice against a system that had transformed money from a measure of labor into a weapon of control. But gold prevailed, and by 1900 America officially adopted the gold standard. The era of silver and the moral balance of 1792 had come to an end. The foundation had shifted, and soon the true power of money would migrate from the mint to the banks. The dawn of the 20th century should have been America's age of triumph. The nation was industrializing, expanding, and entering the global arena. But beneath that confidence, the moral foundation of money was already crumbling. The Coinage Act of 1792 had been written to safeguard the people, to anchor value in something tangible. But as the decades passed, the very meaning of value began to transform. In 1913, a new institution was created, one that would quietly redefine money's purpose forever: the Federal Reserve. On paper, it was designed to prevent financial crises and stabilize the economy. In reality, it concentrated power over money into the hands of a few unelected officials. For the first time in U.S. history, a small group could expand or contract credit, issue or withhold currency, and shape the nation's economy with the stroke of a pen. To the founders, this was unthinkable. The Coinage Act had been a moral contract between citizen and state, money as a fixed measure of honesty. Now, it was becoming a tool of policy, flexible and political. Then came 1929. The stock market crashed. Fortunes vanished overnight. Banks failed, and the Great Depression engulfed everything. As the economy froze, trust in money froze with it. People stopped spending. They hoarded gold because gold was the only thing that felt real. But that trust created a paradox. The more Americans clung to gold, the less the system could breathe. And so, in 1933, President Franklin D. Roosevelt made one of the most shocking decisions in U.S. financial history. He banned private ownership of gold. Every citizen was ordered to surrender their coins and certificates to the government in exchange for paper dollars. Gold, the very metal that symbolized liberty in 1792, was now illegal to own. The government then raised the official gold price from $20.67 to $35 an ounce, instantly devaluing the dollar and transferring wealth from the public to the state without firing a single shot. The Coinage Act had once declared death the punishment for debasing money. Now, the government had done it legally, simply by changing the definition of what money was. The moral shift was profound. The founders had believed that sound money protected citizens from government abuse. But Roosevelt's move proved that the government could now redefine money itself whenever it saw fit. The promise of permanence had been replaced by the convenience of control. And yet, the transformation didn't end there. After World War II, the U.S. emerged as the world's financial superpower. In 1944, the Bretton Woods Agreement tied the global economy to the U.S. dollar, and the dollar, in turn, was tied to gold. On paper, it looked perfect. The dollar was as good as gold. In reality, it was backed by something else entirely, the political and military power of the United States. As decades passed, the illusion began to unravel. America printed more dollars to finance wars, welfare programs, and expansion. Foreign governments held those dollars and started demanding gold in return. By the late 1960s, U.S. gold reserves were dwindling rapidly. In one audacious move, France even dispatched a warship to New York to collect its gold. A clear sign that trust in the dollar was eroding quickly. Too many claims on too little metal. The crisis looked eerily familiar, the same imbalance that plagued Hamilton's bimetallic dream in 1792, only on a global scale. Then came 1971, the year the world quietly but completely changed. President Richard Nixon stepped before the cameras and announced that the United States would suspend the dollar's convertibility into gold. He called it temporary. It became permanent. In that single moment, nearly 180 years of monetary tradition were erased. The dollar was now a fiat currency, money backed by nothing but faith and decree. No more metal, no more measure, only trust. But how long can a system built on promises endure when the promises keep changing? People continued working, continued saving, continued believing that paper would retain its value. But inflation crept in like a shadow. Year after year, the dollar bought a little less. Prices rose not because goods had changed, but because trust had been diluted. The dollar that once represented 24 grams of silver had now lost over 95% of its real purchasing power. A worker in 2025 must earn dozens of dollars to purchase what a single dollar once could. The decline wasn't dramatic. It was insidious, a theft through policy rather than forgery. And yet, the symbols of 1792 still persist. The U.S. Mint still operates. Coins still bear the word liberty. But their metal is symbolic, not intrinsic. A modern dime isn't worth a fraction of its face value in silver. Inflation, once considered a moral crime, is now labeled economic stimulus. Printing money is no longer punished by death. It's celebrated on Wall Street. The irony is profound. The founders crafted the Coinage Act to protect citizens from manipulation. But today, manipulation is the system. Every policy that inflates, every rate cut that devalues, every new trillion added to the national debt is a slow-motion replay of the very crime the founders outlawed. Hamilton and Washington would scarcely recognize what money has become, not a measure of value, but a mechanism of control. Now, in the 21st century, the story takes a digital turn. Money no longer jingles in your pocket. It exists as code. A few keystrokes can create billions. Central banks can freeze accounts or sway markets with algorithms. And on the horizon looms something new: central bank digital currencies. If physical cash disappears, money will no longer represent freedom. It will represent permission. Every transaction monitored, every expense approved or denied, your savings programmable, your financial life traceable. The founders warned against tyranny with guns and armies. They never imagined tyranny by code, but the principles of 1792 still resonate through time. Money must be real, measurable, and honest, or it becomes a weapon. Because when money loses its meaning, trust collapses. And when trust collapses, societies crumble. Rome, France, and Weimar Germany all learned this lesson the hard way, each believing they could circumvent the laws of value until the inevitable collapse occurred. So, what does this forgotten law still teach us? That sound money isn't just about economics. It's about freedom. It's about a promise that what you earn, save, and trade has meaning that transcends politics or policy. Every generation faces the same test. Will money serve the people, or will it serve power? The Coinage Act of 1792 wasn't merely a monetary law. It was a declaration of moral intent, that the nation's wealth should be measured in truth, not just trust. And perhaps that's the message America needs to remember most. If this video gave you some value, then don't forget hit like, subscribe and share anyone who like that type of content.